You ever have one of those moments where you're scrolling through your brokerage account at like 2 a.m., can't sleep, and you're just staring at your portfolio going, is this it? Like, you did everything right. You read the blogs, you listened to the podcasts, you put your money in the S&P 500 like everyone said to do, VOO, the safe choice, the smart choice, and it's going up, sure. But then you see someone casually mention they're up 28% in a year and you're sitting there at 14 and you start wondering if you missed something, if there's a version of this whole investing thing that you just weren't invited to. That's what kept me up one night about 3 years ago. And that's what led me to find something most people still don't know exists. My name is Richard, and I teach what schools should have taught us about money. I spend an honestly unhealthy amount of time doing deep research on financial psychology and why some people build wealth almost effortlessly while others stay stuck grinding for decades. Make sure you smash that like button and hit subscribe if this video helps you view money differently. Now, before we get into the topic, let me ask you something. Have you ever been in a conversation with someone who's doing well financially and they casually drop some investing strategy you've never heard of, and you're nodding along like you know what they're talking about, but inside you're panicking because you realize you might be leaving serious money on the table? That happened to me at a barbecue. A friend mentioned he'd been rotating into momentum stocks, rebalancing twice a year, and I just smiled and changed the subject. But that night, I couldn't stop thinking about it. What the hell is momentum investing? Why don't more people talk about this? And why does it feel like the really good stuff is always hidden behind some wall that regular people aren't supposed to climb over? That curiosity sent me down a research rabbit hole, and what I found was an ETF that's been quietly beating the fund everyone recommends, not by a little, by enough to actually change your retirement timeline. But here's where things get interesting. Most beginner investors, myself included when I started, get told the same advice over and over by VOO, by the S&P 500, set it and forget it. And look, that's not bad advice. VOO is solid. It's diversified, it's low cost, it tracks America's biggest companies. Over the long run, it works. But what if I told you there's an ETF that takes the same S&P 500 companies and filters them through a different lens, a lens that's designed to capture the stocks that are actually moving, and that ETF has beaten VOO by 10 to 15 percentage points in some years? That's SPMO, the Invesco S&P 500 Momentum ETF. And if you've never heard of it, you're not alone, because it flies completely under the radar. So let's break down what this thing actually is, because momentum investing sounds like some complicated Wall Street buzzword, but it's honestly pretty simple. SPMO looks at all 500 companies in the S&P 500 and asks one question: which stocks have the strongest recent performance? Not which companies have the best story, not which CEOs are on magazine covers, just which stocks are actually going up the most right now. Then it takes the top 100 or so of those stocks and puts them in the fund. And here's the key, it rebalances twice a year. So every 6 months, it kicks out the stocks that are slowing down and brings in the new winners. It's like having a fantasy football team that automatically benches underperformers and starts the hottest players. You're not trying to predict the future. You're just riding the wave of what's already working. Now, I know what you're thinking. That sounds too good to be true. If it's that simple, why isn't everyone doing this? And that's a fair question, but let's look at the actual numbers, because this is where it gets real. Over the past year, SPMO returned somewhere between 24 and 29%. VUO, in that same time, returned about 14 to 15%. That's almost double. Over 5 years, SPMO has an annualized return of around 21 to 22% compared to VOO's 17 to 18%. I'm not saying this to hype you up or to make you feel like you've been doing it wrong. I'm saying it because these are real documented numbers, and they matter if you're trying to retire early, if you're trying to buy a house, if you're trying to stop living paycheck to paycheck. That extra 7 or 8% per year compounds into life-changing money. But let's pump the brakes for a second, because I don't want you to hear these numbers and think you should dump all your money into SPMO tomorrow. There are risks here, and we need to talk about them because this is not a free lunch. The first thing you need to understand is that SPMO is way more concentrated than VOO. Just think about it. VOO spreads your money across 500 companies. SPMO focuses on about 100, and here's the kicker. The top 10 holdings make up 54% of the fund. That's more than half your money in just 10 stocks. Compare that to VOO, where the top 10 make up about 39%. So SPMO is placing bigger bets, and that means higher volatility. When the market is going up, SPMO can absolutely rip. But when things turn south, it can fall harder and faster. If you're someone who checks your portfolio every day and freaks out when you see red, this might not be the fund for you. And there's another thing most people don't realize. SPMO is usually pretty tech heavy. Right now, the top holdings include names like Broadcom, Nvidia, Meta, JP Morgan. A lot of that is tech and financials, which means if those sectors take a hit, SPMO feels it more than a diversified fund would. In late 2022, for example, when tech stocks were getting hammered, SPMO didn't have the same cushion that VOO did. That's the trade-off. You get higher upside, but you also get higher downside. So you really have to ask yourself, can I stomach a 20 or 30% drawdown if the market goes into correction mode? Because that's a real possibility. And now here's where I think most beginners get this wrong. They hear about a fund like SPMO, they see the performance, and they think, okay, I need to go all in. I need to sell my VOO and buy SPMO. And that's not what I'm saying at all. In fact, I think that's the fastest way to shoot yourself in the foot. What makes more sense, especially if you're just starting out, is to think of SPMO as a booster, not a replacement. You keep VOO as your core holding, your foundation, the thing that's stable and diversified and boring in the best way. And then you allocate maybe 5 to 15% of your portfolio to SPMO. That way, you're getting some of that extra upside without putting all your eggs in a more volatile basket. It's like adding a turbocharger to a reliable car. You're not replacing the engine, you're just giving it a little extra kick. And this is where the strategy piece comes in, because investing isn't just about picking the right fund, it's about how you use it. If you're going to add SPMO to your portfolio, you need to be disciplined about it. That means dollar cost averaging, which is just a fancy way of saying you invest the same amount every month no matter what the market is doing. It means rebalancing once or twice a year so you're not getting too heavily weighted in one direction. And it means automating as much as you can, because the minute you start trying to time the market or guess when to buy and sell, you've already lost. The whole point of ETFs like this is that they do the heavy lifting for you. You just need to stay consistent. But let's talk about something that almost nobody covers, and that's taxes and turnover. Because SPMO rebalances twice a year, it has higher turnover than VOO. Turnover just means how often the fund is buying and selling stocks inside of it, and higher turnover usually means more realized gains, which can lead to higher taxes. Now here's the thing. ETFs are generally pretty tax efficient because of how they're structured. They don't usually pass a ton of capital gains onto you the way mutual funds do. But with SPMO, you might see a little more tax drag than you would with a buy and hold fund like VOO. It's not a deal breaker, but it's something you need to factor in, especially if you're holding this in a taxable brokerage account instead of a retirement account like a Roth IRA. If you're in a Roth, honestly, you don't even need to worry about it because you're not paying taxes on gains anyway. So now you're probably wondering, okay, Richard, is momentum investing just luck? Like, is this fund just getting lucky because tech stocks happen to do well? And that's a really good question because it touches on something deeper. Momentum investing has been studied for decades, and the research shows that it's a real factor. Stocks that are going up tend to keep going up for a while, and stocks that are going down tend to keep going down. It's a behavioral thing. When a stock is performing well, more investors pile in, which pushes the price higher, which attracts even more investors. It's a feedback loop. Now, does that mean momentum always works? No. There are times when momentum strategies underperform, especially in choppy sideways markets where nothing is really trending. But over the long run, the data shows that momentum can add real value. It's not magic. It's just a different way of slicing the market. But let me give you the other side of this, because I don't want you to think I'm just cheerleading for SPMO. There are people, smart people, who think momentum investing is overrated. They'll say that winners eventually revert to the mean, that what goes up must come down, and that SPMO is just riding a bull market wave that won't last forever. And they have a point. SPMO doesn't have a ton of history in extended bear markets, so we don't really know how it'll hold up if we get a multi-year downturn like we did in the early 2000s or during the financial crisis. That's a real concern. And some critics will say that by the time a stock shows up on a momentum screen, the easy gains are already over. You're buying at the top. There's some truth to that too. But here's my counter argument. If you're waiting for the perfect fund or the perfect moment, you're going to wait forever. Every investment strategy has flaws. VOO can underperform in certain environments too. The question isn't whether SPMO is perfect. It's whether it has a place in a diversified, well thought out portfolio. And I think for a lot of people, especially people who are willing to take on a little extra risk for a little extra return, the answer is yes. So let's get practical. What does this actually look like if you're starting from scratch? Let's say you're a beginner. You've got $1,000 to invest and you want to dip your toe into this. Here's what I'd do. I'd put $800 into VOO. That's your core. That's your stability. Then I'd put $100 into SPMO. That gives you a little exposure to momentum without overcommitting. And then I'd keep $100 in cash or a high yield savings account as a cushion. From there, you just keep adding every month. Same ratios. 80% VOO, 10% SPMO, 10% cash until you build up a solid base. And once you've got $10,000 or $20,000 invested, then you can start thinking about rebalancing, about adjusting your percentages, about whether you want to increase your SPMO allocation or not. But the key is to start small, stay consistent, and don't try to get fancy until you've built a foundation. And here's something I wish someone had told me earlier. The biggest mistake beginner investors make isn't picking the wrong fund. It's not sticking with the plan. You're going to have moments where SPMO is up 30% in a year, and you're going to want to dump everything into it. You're also going to have moments where it's down 20%, and you're going to want to sell and never look back. Both of those impulses will cost you money. The people who actually build wealth with ETFs are the ones who set a strategy, automate their contributions, and then mostly ignore their portfolio except for once or twice a year when they rebalance. That's it. That's the secret. It's boring, it's not sexy, but it works. Now, I want to address one more thing before we wrap up, and that's the question of timing. A lot of people are going to watch this video and think, okay, SPMO sounds great, but it's already up 28% this year. Aren't I too late? And look, I get that fear. Nobody wants to buy at the top. But here's the thing. If you're investing for the long term, if you're investing for 10, 20, 30 years, trying to time your entry point is almost always a losing game. The best time to start investing was 10 years ago. The second best time is today. If SPMO pulls back next month, great. You'll be buying at a discount. If it keeps going up, great, you're already in. The point is to be in the game, to be building wealth consistently, not to try to outsmart the market. So here's your action plan. Step 1, open up your brokerage account and look at your current portfolio. Figure out what percentage is in broad market funds like VOO, what percentage is in other stuff, and what percentage is cash. Step 2, do some research on SPMO. Read the fund fact sheet, look at the top holdings, understand what you're buying. Step 3, decide on an allocation that makes sense for you. If you're conservative, maybe it's 5%. If you're more aggressive, maybe it's 15%. But don't go all in. Step 4, set up automatic contributions. Whether it's $50 a month or $500 a month, just make it automatic so you're not overthinking it. And step 5, review your portfolio once a quarter. Not every day, not every week. Once every 3 months. Look at your allocations, see if anything is out of whack, and rebalance if you need to. That's it. That's the whole game. And look, I know some of you are sitting there thinking, is this really going to make a difference? And I get it. When you're starting from zero, when you're living paycheck to paycheck, it's hard to believe that small moves like this matter. But here's what I've learned after years of studying wealth building. It's never the one big thing. It's never the lottery ticket or the perfect stock pick. It's always the small, consistent decisions that compound over time. It's knowing about funds like SPMO when everyone else is still stuck in the same old advice. It's taking action when everyone else is waiting for permission. All right, I want to hear from you. Drop a comment below and tell me, would you trust a momentum ETF like SPMO in your portfolio? What's your biggest question about this? Are you team VOO all the way? Or are you curious about adding some extra growth potential? Let me know, because I read every single comment and I love hearing how you all think about this stuff. But before you go, I want to remind you where you are right now. You're watching the Money Introduction channel. And this isn't just another finance channel talking about the same tired advice. This is where we dive into the things your high school should have taught you, but didn't. The hidden secrets of building wealth that are kept hidden for a reason. Because let's be real, the system doesn't want you to know this stuff. They want you working that 9 to 5 for 40 years, stressed about bills, wondering if you'll ever get ahead. They want you to think investing is complicated, that it's only for rich people, that you need insider knowledge to make it work. But you're here, you're learning, you're taking control of your financial future, and that matters more than you realize. Every video I put out on this channel is designed to give you an edge, to show you the strategies and the funds and the mindset shifts that actually move the needle. Not the flashy stuff that gets clicks but doesn't work. The real stuff. The stuff that quietly builds wealth while everyone else is still trying to figure out where to start. And if you're serious about escaping the grind, if you're serious about retiring from your 9 to 5 early and living life on your own terms, then you need to subscribe. You need to hit that notification bell, because I'm dropping these insights every single week, and the people who stay in the know are the ones who win. Think about where you could be a year from now if you actually applied this stuff. Not just watched the videos, but actually opened the account, actually made the investments, actually stuck with the plan. You could have a portfolio that's growing while you sleep. You could be the person at the barbecue casually dropping knowledge that makes other people realize they're missing out. And 5 years from now, 10 years from now, you could be completely free. Not just financially comfortable, actually free. Free to quit the job you hate. Free to travel without asking for permission. Free to live life on your own terms. This isn't about getting rich quick. This isn't about hype or false promises. This is about making smarter decisions, one video at a time, until you look back 5 years from now and realize you're not the same person you were when you started. You're financially free. You're in control. You're living the life you always dreamed about, but thought was out of reach. And it all started with videos like this one, with taking action, with refusing to stay stuck where the system wanted you to stay. So if this video helped you see investing a little differently, if it opened your eyes to something you didn't know existed, if it gave you even one idea that could change your financial trajectory, make sure you subscribe. Hit that button right now, because next week I'm covering the ETF that quietly protected more millionaires during the 2022 downturn than any other fund. The one that actually held up when everything else was falling apart. You're not going to want to miss that one. Thanks for watching, and I'll see you in the next one.